Hello everyone. So today's video is all about small cap versus mid cap versus large cap. If you've been watching the market, then you would have seen that recently small caps have had an amazing run and have outperformed the large caps by a margin. But we again hear various market participants say that maybe it's the correct time to shift towards large caps. So in today's video, we are going to learn some very important lessons on what are the market scenarios where a large cap stock does better than a small cap and where does a small cap stock does better than the large cap. You'll understand through some original research done by the Wright research team what is the optimal diversification ratio for each of these buckets, what market scenarios make it appropriate to invest into small caps, and when do we invest more into mid and large caps. We'll explore market regimes, FII flows, volatility, and so much more. So it's a very interesting research done by our team, and please stay tuned to learn some important lessons. But before we begin, please do not forget to like this video and also hit subscribe if you want to see more such insightful content from our team. Let's start with the basics. We all know there's so many people in India who love picking small caps, right? They see huge growth potential happen in small cap stocks. But why does that happen? So let's look at a very basic study, which is how do these stocks work in years when the Nifty is positive versus the years when the Nifty is negative. So if you look at the chart on your screen, you would see that in the years when Nifty has a positive return, small caps have given a 34% average gain versus 31% by mid caps and only 24% by large caps. What that means is that in favorable scenarios, the smaller stocks tend to do increasingly better than the larger stocks. But now let's go to the flip side. And again, if you see the chart, you will see that in those years when the Nifty is hit by some risk event and the returns are negative, during those years, small caps, in fact, are hit the hardest. Average loss for small caps is around 24%, whereas mid cap lose around 20%. Large cap seems to be the most stable during negative years. What that means is that the bigger and more established companies with large financial moats are better equipped to handle tougher situations. What this also talks about is the importance of diversification in our portfolios. While many of us during bull markets get biased towards smaller stocks and invest more and more into it, we have to be aware that the market could change direction, and when a risky scenario comes along, large caps will bring you better diversification, more stability into your portfolio. So maintaining a healthy diversification is key to maintaining a
How
healthy.
does volatility impact return performance across different market caps? The difference in performance between these stocks we would expect or assume is probably more noticeable when we look at it in good times, but maybe in tough or more volatile times, the gap between, let's say, the large cap and the mid caps should get smaller. So let's see if that actually happens. Here's a quick graph for you, and you can see the returns that we've sort of analyzed for low volatile situations and for high volatile situations, and this we've done for large caps, mid caps, and small caps. So let's go through the analysis and some of the data just to get a sense of it. Small cap stocks do really well, or do well at least, in both high and low volatility scenarios. In high volatile years, they've returned around 26 to 27%. In low volatile years, it's around 21%. This shows that small cap stocks are high risk, but they can also give you high rewards. Their performance can swing dramatically based on market trends and what's happening in a trading environment. Mid caps have also done decently well in high volatile situations. They've gone from about 20, 22, 21% in sort of calm markets to about 23, 24% when the markets are sort of getting a little bit more volatile and a little bit more risky. They're also less volatile than small caps naturally. So they're kind of in the middle in terms of giving you that flavor of growth, while also giving you that sort of presence and that return kicker that you sort of get with small caps. Finally, in terms of large caps, we all know large caps are known for their stability. We see a very sort of small variation in returns when you look at it in low volatile and in high volatile scenarios. In low volatile, it's around 15%. In high volatility situations, it sort of bumps up to about 17%. but relatively small sort of variation. And this is the strength of the large caps. They're stable stocks. They can withstand the market's ups and downs, thanks to their sort of size, the diversification of their sort of business operations, and a lot more things there. Ultimately, in terms of diversifying your investments, it's smart to adjust based on the volatility that you're seeing in the market. So naturally, in unstable markets, you might want to sort of lean maybe more towards small caps if you're comfortable with that risk. But if you are someone who is risk averse and wants that stability, then you should probably have a higher ratio or higher allocation towards large caps in that sort of situation.
Now let's look at how do these stocks perform in different market regimes. So market regimes in this chart that you will see are defined as a bullish period when the market is giving you a positive return, and bearish regimes are the zones where the market has corrected by more than 10%, right? So those are the bearish zones. So we did a very simple analysis. We just created average daily returns of these stocks categories in a bullish regime versus a bearish regime. And on the chart of your screen, you see something again very interesting. In a bullish regime, small caps in fact make the most money. The average daily return of small cap stocks is around 0.22% versus mid cap, which are not far behind with 0.21%, and large caps are lagging at 0.18%. So what that means is that small caps or smaller stocks are much more sensitive to the market growth and they recover fast. Let's look at on the flip side. If you look at what you will see is that in fact, during bearish regimes, small caps have seen the biggest outflow or biggest drop at minus 0.3% daily return, whereas mid caps have gained minus 0.32 and large caps have the best return among the three, which is minus 0.28%. What that means is that in bad situation or in riskier situations, large caps are a better bet compared to smaller and medium stocks because people start rushing towards the stability of large stocks and they dump the smaller stocks which they think could struggle in the risky scenarios. What this shows is that small caps are the most affected both in the bullish as well as bearish regime. They have the highest return in bullish periods as well as the most negative returns during the bearish period. So they have the most sensitivity to the market. On the other hand, large caps are the most stable. They have a medium return when the market's rising. Again, not the highest losses when the market corrects. What this also tells us is that it is key to shift the allocation to these different market caps as the market changes. So in a bullish regime, we want to shift more towards maybe small caps, but as the market corrects, we have to move towards the stability of larger stocks.
We've covered quite a bit in this video so far. So let's look at some other factors that can also impact how your portfolio allocation may change. In Indian markets, we all know foreign and institutional investors or FIIs can have a massive impact. So do domestic institutional investors, the DIIs, so to speak. And all of this can have an impact in terms of the return that you're getting from the large, the mid, and the small cap stocks that you've sort of held. So here's a quick graph. If you look at this graph, you can see, from 2007 till about 2023, we can see somewhat of a pattern emerging. DII investments seem to counterbalance FII outflows. This could also mean that DIIs may be cushioning against any sort of foreign capital flight that the stock markets might be seeing, which is why there's this sort of counter-cyclical pattern there as well. And if we look at, let's say, specifically what's happening on the returns when the DIIs and the FIIs are sort of making their impact on the market, let's sort of look at that in a little bit more depth. In the first graph, as you can see here, when FIIs invest more, when there's a positive flow, small cap stocks gain the most with returns of about 4.5%. Then mid caps are giving you around 4.3%, and large caps are giving you about 3.5%. But when FIIs are pulling money out of the system, out of the stock markets, and there's a negative flow, there's a negative FII flow, we see all stock types are sort of falling, but small caps are typically the hardest hit and losing around 2.5%. This also shows that FIIs probably have a big effect on the market, especially in the small cap space where a lot of the liquidity and the sort of sensitivity of these stocks is to a lot of the sort of external fluctuations. In the second graph, we can look at the DII flows. You can see that here. Again, here you can see that with the DII investment, when there's a positive flow, the difference in returns across stocks is smaller. Small caps are giving around about 4.88%, mid caps around 4.56%, and large caps around 3.98%. When DIIs reduce their investments, the negative flow, the decrease is less severe than what we saw earlier, with small caps only dropping by about 1.2%, which kind of suggests that the domestic investment, institutional investments, don't necessarily swing the market or move the market as much as the FIIs do. And the FIIs can really push the market up or down depending on which sort of sector or which market cap you're sort of in. And what this means is that naturally, if you're in the small cap space, you should be aware of FII and DII flows and how that can hamper maybe the investments that you have. DIIs naturally are creating a more stable environment in that sense. Their actions are not necessarily leading to any major movements in the market, and their impact is ultimately more evenly spread across all types of stocks.
Like we've been saying, diversification is the key when you are trying to find the correct mix of assets to have in your portfolio. While small caps can give you the highest return in bullish zones, having a healthy allocation to large caps will make sure that you don't see very sharp corrections during bearish regimes. Again, talking about diversification, there is a very interesting bit of research that Akash from my team did about the impact of diversification on these three market caps. So the first chart that you see, it is showing the impact of diversification on the portfolio returns. On the x-axis, you will see diversification rising, and on the y-axis, you'll see the return rising. What this sees is that as diversification rises in a large cap portfolio, the returns also rise. What it means is that for larger stocks, diversification only adds value. But if we move on to the mid-cap stocks, we will see that's not the trend. In the mid-cap zone, what you would see is that at the lowest levels of diversification, we are seeing the highest returns. And as the diversification score increases, the returns have also decreased a bit. What that means is that stock selection plays a most important key role when selecting mid-cap stocks. So therefore, probably we see more stock pickers in the mid-cap universe in comparison to the large cap universe. We have the third interesting chart, which is on the small cap stocks. Here, the trends are a bit strange. What we see is that rising the levels of diversification, in fact, gives better returns initially for small cap stocks, but beyond a certain limit, if you increase diversification for your small cap portfolio, it impacts the return and your returns go down. What that means is that too much diversification in small caps is not good. There is an optimal level of diversification that is more suitable for small cap stocks. So again, diversification is key, and it impacts these different types of stocks differently. Along with diversification in today's market, we have to keep an eye on the FII and DII flow as well. As FIIs come to India seeking growth, whenever they enter, we see a big impact in the high growth areas, especially small caps. And on the exit of FIIs, we see a dent happening in the small cap space more prominently, as DIIs provide a steady stream of investment which can balance the changes caused by the foreign investors. So what is the key takeaway? I think the key takeaway is that Indian stock markets need you to be flexible with your stock allocation. In certain scenarios, in high growth scenarios, small and mid caps definitely can give your portfolio that growth that you're seeking, but in high risk scenario, large caps, in fact, will give you the moat and will give you the stability that your portfolio needs. So maintaining a healthy diversification, shifting along with the market, being tactical is the key to keeping your money safe while also growing it at a healthy pace. So I hope you enjoyed this video about large, mid, and small caps, how the diversification changes the returns of these different portfolios, and how you can manage your portfolio allocation to these category of stocks in different scenarios. Be sure to write your comments if you like this video, and do let us know what you would like us to talk next. And do like this video if you enjoyed it. See you in the next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to